Welcome back. You're watching Stock Watch with me, Zinati Kuma, and joining me to unpack your stock-related questions tonight are Jean Pierre Verster from Protea Capital Management and Shane Watkins from All Weather Capital. Be sure to send your questions via email to stockwatch@bdtv.co.za or via SMS on 41392 or on X @BusinessDayTV using the hashtag StockWatch. Thank you so much for your time, gents. We're coming back to some red screens, starting off the second quarter. Shane, I want to start with you. What's keeping the markets under the weather today as we start off the second quarter?
So Zanati, hello to you and your listeners. So the mining shares did very well and property financials did quite badly. And the answer to this is it's a little bit of a long story, but during COVID, initially there was a very high demand for goods and not much demand for services. People didn't travel or go out or eat out or so on. In the opening up trade, there was a switch back into services and less demand for goods. There's now been a rebound in demand for goods. And essentially, we saw some very good manufacturing data, that's global data coming out yesterday. That has resulted in higher commodity prices. Higher commodity prices tend to make people worried about inflation. And so there was a sell-off in global bonds and financials. And that just happened in our market today. As you saw, the commodity shares did well and property financials did badly. That's essentially the narrative that we're seeing unfold.
Yeah, and indeed, also quite interesting, Sasol, not always a stock that follows the oil price, but we did see it following the high oil price today. We did see oil trading at a 5-month high. JP, do you think that this does significantly support Sasol at this point, a stock that investors have been on different sides of the fence about, or not?
Yes, so it is a contentious stock at the moment. Optically, it looks very cheap, especially if you plug in the current oil price. It does seem like Sasol's going to make very nice earnings. They could even make some free cash flow, which should be a nice change from the recent past. But my concern is still the US operations. There's basically too much plastic in the world, too much plastic in the oceans, and more we are ingesting microplastics. So that is what the Lake Charles operation does. It effectively manufactures plastics. And they obviously have also got the dirtiest single plant in the world, Secunda, which they also need to solve for. So it's very nice if you can make some oil out of coal, but if you do it in a very dirty way, I don't think that's sustainable. And therefore, I think that even though Sasol looks optically cheap, it's in my mind a value trap, and I would not get involved in Sasol.
Which side of the fence are you on in terms of Sasol at this point, Shane? JP, very cautious about Sasol at this point, even though I'm sure to a lot of investors that have been thinking of getting out of Sasol but haven't really found a nice price, asking if they should hold, are quite happy with the uptick that we have seen in the share price today.
Well, Zanati, I have to say that every dog has its day. And Sasol, has been, you would say, a dog. It's been an appalling share price performer. And it's actually a very badly managed company. And as JP says, it also has some structural problems. But global chemical prices appear to be recovering. The oil price is up 10% year to date. And, it is possible that, as JP says, that they might produce earnings and perhaps even free cash flow. So it is starting to look cheap. It's starting to look sort of interesting if chemical prices hold up. But I've got to say, one of the things that's held Sasol back has been the fund managers have been moving money offshore with the change to Reg 28. And Sasol is clearly not the best oil company in the world. It's probably not in the top 100. So people have sold Sasol and they've bought Total or BP or Shell or other oil companies globally. So no local fund manager that's looking for the best oil company in the world is possibly going to buy Sasol. But it is possible now, with the share price down, 60% over 12 months, that maybe this is a good entry point. Well, but you're definitely not buying the best company.
Yeah. Well, quite interesting, as we're talking about the higher oil price, which obviously could mean bad news for the inflation picture, the rand is actually holding up very nicely. Even with that, there's a question here. I've got a position and it involves the rand going into the upper 19s. I want to know from the panel what's keeping the rand so resilient lately compared to the weakness we saw at the beginning of the year. JP, any insight there?
Well, if you compare it to the beginning of the year, I mean, that's 3 months. It's a very short period to try and explain a change in investor sentiment. If you zoom out a little bit and look a bit longer term, I would say that fundamentally the rand is still undervalued. If you look what we can buy with rands, equivalent goods like a McDonald's burger, for instance, it's one of the cheapest places in the world to buy a McDonald's burger in South Africa, which implies that the rand is undervalued. But at the same time, people are undervaluing it because they are nervous. We have elections coming up in a few weeks' time, and depending on the outcome of those elections, we could have a government that is effectively disempowered, which effectively is good for the economy, I would say, if we have a coalition that leads to not any one dominant segment controlling the country. Or you can have a positive outcome and a more business-friendly coalition. And if that happens, you can see the rand strengthen. So any movements of the rand in the next few weeks, I can say in advance already, the very easy suggestion or explanation is it's because of the elections and people wondering what will happen in the outcome of the elections.
And talking about nervousness, we've also seen the gold price momentum continuing there. Shad, I just want to ask from you, I mean, what are you making of investing in gold at this point? Would you be going in, because it doesn't look like there's going to be a cooling down of nervousness anytime soon? Or would you kind of maybe wait a little bit? And I don't know what you'd even be waiting for. Shane?
Oh, Zanati, so look, the gold price is, we have a policy in our business to be roughly even weight gold. Gold is a very hard thing to forecast and predict because by definition, you buy it for uncertainty, and uncertainty is not predictable necessarily. So, Harmony was up 30% last month. So it's a place that it's easier to try not to lose money than what it is to make money. But I've got to say at sort of $2,250, gold shares look good. And in actual fact, if you think about the 4-quadrant model that Bridgewater used, which is growth and inflation, the slightly higher inflation and higher growth quadrant is good for gold and good for emerging markets. So you could well see a situation where the rand strengthens a little bit and the gold price keeps going up and gold shares do very well.
I know, JP, a lot of analysts also just see gold as a trading opportunity and not necessarily for long-term investment. What would you be doing at this point? What is this price momentum signal? Should you actually be leaving gold at this point or not?
I can understand why someone would want some physical gold for the long term, because it is a protection against inflation and the debasing of the currency. But what I do believe is for trading and not for long-term investing is the shares of mining companies.
Yeah.
And my reasoning is that ultimately, even though a higher gold price is good for those companies, a higher gold price is normally also associated with higher inflation. And unfortunately, those mining companies need to have expenses and pay for those expenses in fiat currency. So that negates the higher gold price. So if you want some exposure to this shiny metal, rather buy an ETF that's purely based on the price of gold and keep your trading hat on when you look at the mining company shares that try to get the gold out of the ground at a decent price.
All right. Well, let's shift gears to transaction capital. Could you please discuss transaction capital? Any advantage in remaining in transaction capital now that WeBuyCars have been removed without compensation? Current transaction capital shareholders are not getting WeBuyCars shares. Should one hold or sell transaction capital? Shane?
So, Zanati, I mentioned the change to Regulation 28, which essentially allows pension funds to move from having 30% offshore to having 45% offshore. In that process, a huge amount of money has been selling South African equities and buying equities offshore. And the only equities that have not been sold have been the very best companies that South African fund managers can invest in South Africa. And the peripheral shares have all been sold down quite aggressively. And it's not hard to find some very good companies on PEs of 6, 7, 8 in our market. Now that valuation metric is actually below the valuation metric that companies are trading at in private markets. So it's very odd to find a listed company on a 6 PE, and in private markets, companies would be trading on 8, 9, 10 times. So I would say in an environment where you're already spoiled for choice, there are some extremely good, quite low risk businesses on PEs of 6, 7, or 8. I don't think that your risk reward in transaction capital is adequate for me to buy that over some better quality, lower risk businesses.
And actually, just JP, there seems to be some confusion as to whether transaction capital shareholders are actually getting anything from the listing of WeBuyCars. Are they not getting anything? What have you gauged from that? And also, what would be the point of still staying in transaction capital if you're not getting anything for WeBuyCars?
So transaction capital shareholders will get WeBuyCars shares ultimately. I just think it's not necessarily on the day that WeBuyCars lists.
Okay.
It's a few days later. But if you buy WeBuyCars tomorrow, you will. If you buy transaction capital tomorrow, you will get some WeBuyCars shares in the next few weeks.
Okay.
So I do believe that if you look at the package you are getting effectively some WeBuyCars shares, and then you're getting the rump of transaction capital that's left over after the WeBuyCars shares are unbundled. And that rump, I think, has got a little bit more value than the current price implies. When transaction capital went to 10 Rand, above 10 Rand, then maybe it was a bit fully valued, the rump. Where it is now, maybe a little bit of value in it, but it's touch and go. So I actually like the idea of buying a company that is being broken up, and you'll get some shares unbundled to you that you can hold directly, and potentially some positive surprise on the rump. So we're still a holder of transaction capital shares.
All right. Okay. Yeah, JP, actually just sticking with you, because if you're not already in these and you want a piece of WeBuyCars, what would be the better option if you're not in transaction capital? Would you be going for transaction capital or waiting for the WeBuyCars listing?
So there has been one placement already of WeBuyCars shares at an implied price for WeBuyCars that they thought would get them, call it 24 Rand per WeBuyCars shares, per share of WeBuyCars, and they didn't quite get that. I think it was 19 Rand something.
Yeah.
So I think keep your eye out on the listing, because you could buy WeBuyCars shares in the market. And as a rough rule of thumb, I would say, if you could get WeBuyCars shares below 20 Rand, preferably below 19 Rand per WeBuyCars share when it lists next week, that seems like a reasonable deal. And if it's trading above 24 Rand, then it's potentially a bit full. So yes, have a look at WeBuyCars when it lists separately next week.
Let's get to more questions. Naspers and Prosus. JP, starting with you. Are Naspers and Prosus still buying back shares? If so, for how much longer, and what would the target price be? I think I did see Sens there on the share buyback program today as well. JP, for how much longer, and what would the target price be?
So it's a continuous share buyback, and it's being funded by the sale of Tencent shares in Hong Kong. And Prosus still has a lot of Tencent shares to sell. So I don't foresee any end to the share buyback. They can keep on going for a very, very, very long time, which is a good thing, because the transaction creates value. You are selling the Tencent shares at their full value in Hong Kong, and then using the proceeds to buy shares back in the group at a price which is at a discount of the look-through value of the Tencent price. So that means I don't have a target price in mind. I just know that the buyback works, it creates value, and we have a better capital allocator now at the helm of this group that potentially will make better decisions when it comes to smaller acquisitions, not overpaying, and therefore I'm still optimistic about Tencent, and therefore optimistic about Naspers and Prosus trading at a significant discount to the sum of the parts as well.
Shane, on your end, do you think that the environment and obviously what they're doing right now, the fundamentals are supportive of a more optimistic prospects for Naspers and Prosus?
So, Zanati, I would say that if you want to make your life simple for the next 5 years, all you have to do is buy either Prosus or Naspers. 80% of the NAV of Naspers and Prosus is Tencent. Tencent is a very large, I mean, at one point it was one of the top 10 companies in the world by market capitalization. But Tencent is an extremely good business. It's hugely cash generative. About a quarter or a third of the company is in cash, if you add up the listed assets plus the cash on the balance sheet. It trades probably on around a 10 PE forward, and it's likely to grow its earnings at 20% per annum at least for the next 3 years. So, Tencent on its own merits is a great business. And then, as I said, 80% of the Naspers and Prosus NAV is Tencent. And Tencent are buying back their own shares, and Naspers and Prosus are also buying back their shares. So, I mean, it's not hard to make an extremely strong investment case for any of those three companies.
All right. What about MultiChoice? There is a specific question here. MultiChoice has an offer of 125. Why is it trading at 112 Rand? I think when Canal Plus first came out with the offer, the share price aligned with that price, but now not so much. JP, any idea?
Sure. So firstly, on a technical point, there is no offer yet. There's an indication that an offer will be made soon. So we are waiting for the details of that offer that must be made, I think, in the coming week, before the next week, Monday. And the details of the offer will be in a circular that gets released. And it's such a big deal of a company that operates in so many jurisdictions, plus the additional complication about the Electronic Communications Act that has got a certain limit on foreign shareholding of any entity that has a broadcasting license, which MultiChoice South Africa has, that it will take a long time for this deal to be consummated, to be finalized. And that is why it's trading at a discount to the expected offer of 125 Rand, because if you wait a whole year before you get your money, and you want at least 10% because of a risk-adjusted return for a year, then you get the current share price. So it's not completely out of line with what I would have expected.
Shane, do you think that a person could be trading a MultiChoice and buying MultiChoice in anticipation of this deal? Or should they be looking at the fundamentals, the financials of what the company is at this point?
So the company's in play. As JP says, it's likely a deal will go ahead. But, if you think about it probabilistically, 125 Rand with a 95% certainty gives you 118. And then if you say, well, it's going to take me a year to get my money, that gives you like 112. So that's where the share is trading. So I think the market is not irrational in pricing this, at the current share price. I think you probably have to take into account that it's possible that the offer will have to be increased. But on the other hand, it's also possible that the transaction won't go ahead. I mean, we've seen our competition authority get involved in transactions and behave in a very irrational way. And it's not certain that this transaction will go ahead. So I would say the current pricing looks about right to me.
All right. Let's go into chips. AMD, this stock has lost traction over the last month or so. Still a hold, or should I take some profit now that it has gained 115% in my portfolio? I think I read, when was it, last week or 2 weeks ago, when the Chinese authorities said that government institutions should stop using computers with chips from AMD and Intel. And yeah, JP, is that why the share price has lost traction at this point? And obviously it has gained over a long period of time. Should, if you are in that stock, still hold or not?
So again, how well the stock has done or not depends on your time frame. It's done very well over the last few months because of this AI craze, with everyone looking if someone can potentially compete with NVIDIA. And seeing that AMD has got a very strong foothold in the GPU market, the graphic processing unit market, the expectation is that if someone is going to be able to compete with NVIDIA, it will be AMD. But at the moment, no one is touching NVIDIA because they don't just have the right chips, they also have the software to make sure that you can use the chips for artificial intelligence applications. So when this type of dynamic happens, where there's a clear leader and a few other companies that are trying to dislodge the leader, I generally prefer the leader because winners tend to keep on winning. And even though a lot of competitors try, they generally don't get it right to overtake the leader. So between AMD and NVIDIA, I prefer NVIDIA, but I still believe there's actually a bit of a bubble in the whole AI space. So I would prefer other semiconductor companies that aren't so focused on AI the way that NVIDIA or AMD are.
I mean, but second place could be more motivated to work harder to overtake the leader. Shane, what do you make of AMD at this point? Yeah, and also just answering the question, would you hold or would you maybe rather go into the leader at this point?
Zanati, I think it's pretty evident that in the whole graphics GPU or chip manufacturing space, the easy money's been made, right? So, you know, from here, the returns will probably be more moderate. And in any event, you know, these companies they're kind of growth businesses, and a lot of the profits that investors are anticipating are some way in the future. And the longer interest rates stay high, the less those future profits are worth. So I think that, you know, although it's hard to predict if you are in some kind of mania, it's hard to predict where share prices will go. I would say that, you know, probably you should bank your profits. In the United States, a lot of people don't bank their profits for two reasons. The one being they don't want to crystallize taxable gains in America. And the other thing is, in the United States, about 2/3 of all inflows into the market go into passive products. And those passive products, by definition, just buy the largest companies. And NVIDIA and these other companies are the largest companies. So the dynamic of the US market kind of makes me think that this can carry on for a bit, but the shares are not cheap. And, you know, from here, anything can go wrong.
Yeah. I mean, just earlier on, we were talking about gold. And Shane, you did also mention that Harmony has also seen some momentum in its share price. There's a question here specifically for JP. JP, is Harmony a short?
I believe it is. I generally don't like talking about my shorts. And I don't mean the pants I'm wearing. I mean the companies that we make money when their stock prices fall. But Harmony is one of those. And it's nothing against the management. It's nothing against the company. It's just the dynamic that the share price has gone through the roof on the back of the higher gold price, which is understandable. But as I said earlier, and you saw a little bit of that today with the Goldfields announcement, gold miners tend to disappoint. They tend not to capture the upside when the gold price spikes because their costs also increase at an above average rate. So on that basis, I do believe that Harmony is a short at the moment.
Shane, are you a shorter? And if you are, would you short Harmony Gold at this point, or are you more on the long-term fundamentals of it all?
So Zanati, I would agree with JP that gold mines are not good businesses. They very, very seldom earn their cost of capital. But I would say that there are probably easier places to make money on the short side than being short a gold share. You know, this is a situation where anything is possible. And, you know, as I said, the share was up 30% last month. Could it be up 30% again this month? It's not an unrealistic scenario. It's certainly something you need to think about. And so I think gold shares are generally a place to, if you want to make money on the long or the short side, it's best to kind of have an even weighted bet. Shorting gold shares is risky. If the gold price keeps going up, the share can double and double again. You know, I mean, it happened in Nenegate. I think in a matter of 2 weeks, Harmony was up almost 100%. There are very few shares that can perform like a gold share. And you don't want to be shorting it and covering it 50% higher.
Yeah, I hear you. All right, let's get to your stock picks for today. JP, what will it be?
It's an industrial South African-based company, the type of companies that no one likes at the moment. It's Bell Equipment. The good news is that they export. So while their costs are in rands, their revenues are predominantly in non-rand currencies. And with the rand on a long-term weakening trajectory, that's reasonably good. They've got a very strong market in the mining equipment business, articulated dump trucks and a few other excavators and things that you might see, which we call yellow equipment. Obviously, the family has got a controlling stake, which is an interesting dynamic. Bell came out with results just last week, which were very good. It's trading on like a 3 times price earnings ratio. But the big disappointment is that they did not pay a dividend with these latest results. So the share price is under a little bit of pressure today because of that. I would look through that and look at the company and seeing how healthy the company's position is. And if the family does want more of this company, they would need to pay a premium to buy out the rest. And if not, I think the pressure will build that they do start paying dividends again because the financial performance of value committee is very strong. So that's my stock pick tonight.
All right. Shane, on your side, what will it be?
So now you're also going for a KwaZulu-Natal-based company, Spar. This is a recovery story. I mean, remember the Spar share price was 220 Rand 2 years ago. It's now 86. The business has had some inept and compromised management, which have been changed. I think now they have a good chairman and a good CEO. And I think, it's a business that even in its current situation with all its missteps will still earn around 9 Rand. The share's 86 Rand, so on very depressed earnings, it's about a 10 PE. We think that the business could get to about 12 Rand earnings over the next 18 months. If you put that on a 12 PE, that's sort of 144 Rand. The share's 86, so 50% upside from here. It's not hard for them to fix their problems. They've got to sell Poland, probably sell Switzerland, and they've got to fix the SAP system, and then maybe deal with some sort of peripheral litigation that relates to the conduct of previous management. So it is a turnaround, but if you look at ShopRite, you're paying 70% of ShopRite's market cap for sales. In the case of Spar, you're paying 11%. So I think it's worth a punt on the long side on the basis that the current management are likely to fix the problems that they have.
All right. Well, thank you so much for your time and for your analysis today, gents. Really appreciate it. That is all for tonight's Stock Watch. Thanks to our guests, Jean Pierre Verster from Protea Capital Management and Shane Watkins from All Weather Capital. Up next, The Close. Stay with us.